Today I want to talk a little bit about the process of what it looks like to go through getting a loan from BJF Lending and give an example deal of what a loan would look like as far as the numbers are concerned. BJF Lending lends to real estate investors who purchase single family and small multifamily residential real estate for flips or to purchase with a private money loan from BJF Lending in order to later refinance that deal as a buy and hold rental property. We also offer loans for short-term financing, bridge loans. For example, in a multifamily deal, sometimes a real estate investor wants to get a short-term bridge loan in order to be able to close into that deal in a timely manner, and then in a short time after that, without even doing a value add, refinance out into traditional financing. The benefit of that bridge loan is just that it moves up the timeline of how fast they can close into the deal. Oftentimes, there can be opportunities for real estate that require a fast, short timeline to close into it in order to be the investor that gets the deal. So that's a leg up on the competition in the form of a bridge loan. So the process from the lens of BJF Lending is that we aim to develop long-term relationships with real estate investors. We would prefer to do many deals, many loans over the coming years with a real estate investor as opposed to just having a one-off relationship. So the first part of our process is to get to know our potential borrower and client through some financial vetting. We just do an underwriting process to look at a borrower's past projects, their experience with the types of deals that they're looking to do, and the financials and cash reserves that they have, other types of financing available to them. For instance, in the example of an investor wanting to buy the property, do a value add, and then refinance out into traditional financing, we want to make sure that that buyer is in a position, that investor is in a position to refinance out at the end of the deal. And so that is the first step of the process, is for us to get to know our potential borrower client. The next step in the process is when our client has a potential deal on the table that they want us to look at to give them a loan, a private money loan for the acquisition and potentially renovation of that project. Then we go into our initial assessment of the project, look at the basic numbers, look at the business plan that our client has for that project. And if everything green lights, we already have our borrower client green lit for their underwriting and their financials are solid and meet all of our requirements. And then the property undergoes our initial assessment, just a macro perspective, quick look at the numbers, the business plan, and make sure it looks like a prudent deal. It looks like the numbers work. Then we bring it into our full underwriting process. We bring the property into our full underwriting process, which is a much more in-depth look at all of the numbers, the scope of work, if there's a renovation involved, the exit strategy, the timeline, the sub-market and the regional market as a whole. I did a video a few days ago, the video before this, that I talked about macroeconomics in a given sub-market or region at a national level, which is less relevant, but we look at that sub-market and regional market just to determine if this is a project that will be undergoing, let's say, a 6 to 9 to 12 month renovation value add. We want to see what the trajectory of that market is. If that market is softening, we're going to want to make sure that that investor is poised and building into their numbers a softening market which could reveal itself 6 or 12 months down the road in the form of less value, less of a potential value, whether it's a for sale, a retail sale, or a rental. We just want to make sure that for the exit strategy, they're positioned properly and expecting what's coming if the market is softening, or if the market is strengthening, that gives us a little bit of reprieve in the form of potential appreciation. Although we don't bank on that, it's just a consideration with the underwriting of the property and the market. There are a lot of considerations. I won't go into all of the details of the full underwriting process. Anybody that's interested in learning more about our full underwriting process, feel free to go to bjflending.com and reach out to me, to us, and I'll be happy to speak with you and give you a more in-depth overview of exactly what our underwriting process looks like. So that's kind of the three-phase process that we bring the potential borrower client through: the initial assessment of the deal and the property, and then the full underwriting of the property. And if the full underwriting of the property checks out and everything looks good, what we will do is come up with a loan amount and terms for that loan in the form of what the interest rate on it will be, what the required down payment will be. If it's an extensive renovation with more than, let's say, a 10 or 15% cost of renovation of the entire value of the project, we'll probably be setting up a draw schedule. Although in 2025, we're not doing major renovation loans. It's still something we can look at and determine in the underwriting phase what the terms of the loan will look like. So if everything in the final underwriting phase, in all three phases, including the final underwriting phase, looks good and gets green lit, then we're going to close into that deal with our borrower and fund them with a loan. Now, BJF Lending utilizes our investors in the form of investment capital to fund these loans. We use what's called a participation agreement in the cases where we use investment capital. And so I just want to give an example here of what a possible deal would look like and what that would look like from the lens of BJF Lending, as well as a potential borrower client, and to show our investors what that would look like. So let's say that an investor, real estate investor, house flipper, comes to us with single family, 3 or 4 bedroom home that we determine is worth $400,000 after all of the renovations are done, and they're looking to do a retail exit on this property, which means they're just going to sell it as a move-in ready property to a home buyer. So this $400,000 property, oftentimes when people come to us looking to flip a house, the reason that they're able to build a profit margin into this deal is because there's usually some type of situational and or physical situation, dilapidation, physically, financial situation going on behind the scenes that allows them to buy a property like this at somewhat of a discount. So let's say that this property is in need of some carpet, paint, some surface level renovations, and maybe a light bathroom renovation, and just some cosmetics in the kitchen. So let's call it a $50,000 renovation. So a lot of people will call this $400,000 after repair value of the house, the ARV. So the ARV of $400,000 minus $50,000 in repairs gives us a number of $350,000. BJF Lending one of the main criteria, once we go through the full underwriting process of the property, we look at the complete scope of work of the renovation. We look at every line item of the materials. It's one of the strengths that BJF Lending has, is I personally have been in the house flipping business and operated as a renovation and building contractor, and have been involved extensively in residential and larger commercial resort redevelopment and renovation contracting construction projects. And so we have a lot of experience with where the market's at, what construction costs are, red flags to look out for in the physical property itself, as well as the business plan of the construction aspect of things, who they're using for contractors, the actual contracts that they're using to set it up, make sure all the insurances are in place to make sure that this is a safe deal. So BJF Lending looks at all of these factors, comes to this $400K ARV minus $50,000 in renovation repair costs, $350K. We, as far as a loan to value ratio, never want our loan to be more than 70% of this $350,000 number. So in this case, 70% of $350K is $245,000. And so that $245,000 as a 70% loan to value of $350K would be the maximum loan amount that we would loan on this particular project. Now, depending on the borrower client and their track record and our established relationship with them, we also will include and do some of the renovation costs in the form of the loan. But there's considerations with the underwriting of the borrower that we talked about, their track record, our established relationship with them, their cash reserves, financial situation. And so the construction costs can be built into the loan, but these are the general numbers, and as it pertains to the after repair value, the renovation costs, and then our 70% loan to value ratio, depending on how big the construction project is. Again, in 2025, we're not getting into huge, extensive renovations. We're doing more just cookie cutter, surface level renovations and repairs. And so in the event that there are more extensive renovations, let's say this was a $400K ARV house, needed a full gut rehab, full kitchen, bathrooms, ripping out flooring and things like that. When we start to structure the loan and we're looking at a bigger number for this renovation cost, let's say $175,000, $200,000, then we're getting into a little bit more complexities with how the loan is structured, and we would have draw schedules, for example, that would require inspections of portions of the construction process to make sure that everything's on track before the next draw goes out from the loan. But we're not going to be getting into that as much in 2025. We're just doing cookie cutter deals. This is a good example of what a deal would look like. Depending on our relationship with that borrower and what we've come up with the underwriting portion of that borrower, how many deals they have out. There's also going to be down payment requirements. We just want to see some skin in the game from our investors and make sure that we're setting everybody up for success. Again, we are all about building longer-term relationships that we will be doing business together for years to come. So we always want to be setting our investors up, our real estate investors, our borrowers, for success. And so that is a general overview of what a loan would look like. our investors, if we're using investors in the form of participating investors in the loan, the return to their investment capital, we're looking at double-digit returns to their investment capital. Our overall loan terms to our borrowers in 2025, we're doing pretty standard private money rates, looking at 12%, and there's going to be some discount points up front, and depending on the term of the loan, things shift from there, but we're very transparent up front. We like to work with our clients to make sure that we are helping them to vet the deals and make sure they're getting into winning deals that are profitable. In my house flipping days, it wasn't uncommon to be seeing 30 to 40% or above gross profit margins on flip deals. So we always want to be making sure that we're creating win-win-win situations for BJF Lending, for our borrowers, for if we have investment capital coming into the deal, that we're properly going through the full underwriting process and setting everybody up for a winning deal so that we can keep everybody moving into 2025, 2026 with profitable deals and making sure that everybody's winning with us. So if anybody has any questions, if anybody wants to talk to me about any of this, feel free to reach out, bjflending.com. I'm happy to discuss, and I'm looking forward to a prosperous and healthy 2025. Thanks, guys. I appreciate you.